The epicenters of the artificial intelligence explosion are currently engaged in a spectacular, multi-billion-dollar game of financial cross-investment. You've likely encountered the so-called spaghetti diagrams circulating in the media, visual representations of how foundational companies, such as OpenAI, are injecting capital into their core chip suppliers, or conversely, how chip manufacturing titans like NVIDIA are funding the very clients who purchase their high-demand hardware. The peculiar nature of these agreements first struck me when CoreWeave, a significant NVIDIA chip purchaser that operates data centers and leases compute time, filed for its initial public offering, IPO. The prospectus revealed that NVIDIA already held approximately 5% equity in the company. Following a period of tepid investor enthusiasm, NVIDIA committed to anchor the deal with a massive $250 million order at a firm share price. This circular arrangement led financial journalist Bryce Elder to describe the dynamic as an Ouroboros, the ancient symbol of a serpent devouring its own tail. A more contemporary, yet equally accurate metaphor might be an extension cord plugged into itself. To the uninitiated, this setup might resemble a perpetual energy machine. But as anyone with basic knowledge of electricity understands, this configuration will never power a single home appliance. It fundamentally requires external energy to initiate motion. This analogy, broadly speaking, captures the current state of AI infrastructure financing. While the sheer scale of these circular deals has convinced some that the AI value chain is thriving, others are voicing significant concern over this intrinsic circularity. Two dominant corporations sit at the nexus of virtually every financial diagram: OpenAI and NVIDIA. Both organizations are clearly executing a calculated strategy to ensure that every player in the ecosystem, from core chip suppliers to cloud renters and end customers, possesses a strong, vested interest in their reciprocal success. OpenAI's latest moves demonstrate this profound entanglement. The company secured a $300 billion cloud infrastructure agreement with Oracle, formed a $10 billion partnership with Broadcom for custom chip development, and finalized strategic alliances with major memory component manufacturers. According to insightful analysis from UBS, OpenAI's memory commitments alone account for approximately half of the world's existing manufacturing capacity. Meanwhile, the investment flows are not unidirectional. NVIDIA has reportedly pledged up to $100 billion in investment capital to OpenAI. In a direct return on that investment, OpenAI will commit to purchasing millions of NVIDIA's specialized AI graphics processing units, GPUs. AMD has also entered this high-stakes game. OpenAI has reportedly agreed to procure tens of billions of dollars worth of AMD chips. In a highly unconventional maneuver, AMD granted OpenAI the right to purchase 10% of its stock for a single cent per share, contingent upon AMD reaching specific share price benchmarks and OpenAI deploying the chips. As explained by financial columnist Matt Levine, if OpenAI announces a significant partnership with a publicly traded company, that company's stock price tends to soar. Thus, OpenAI could effectively finance its own purchase, acquiring the chips for cash, receiving the stock, and then seeing the announcement cause the stock to rocket, thereby effectively reimbursing OpenAI for its initial capital outlay. In this self-feeding structure, Virtually everyone involved is positioned to win. Amazon quickly established its own version of this circular infrastructure loop. The tech giant invested over $8 billion in Anthropic, the firm responsible for the highly successful Claude chatbot. In a direct strategic exchange, Anthropic formally committed to utilizing Amazon Web Services, AWS, as its primary cloud infrastructure provider. This arrangement mandates Anthropic to train and execute its vast models on Amazon's proprietary AI silicon, lease compute resources from AWS, and integrate Claude into Amazon Bedrock, the company's enterprise AI offering. Effectively, Amazon is financially sponsoring a company that will utilize its bespoke chips, operate entirely on its cloud platform, and simultaneously assist in marketing its services. Not to be outdone, Google has aggressively entered this very same financial orbit. Anthropic recently finalized a staggering deal with Google to access up to 1 million of Google's tensor processing units, TPUs, slated to bring over a gigawatt of compute capacity online by 2026. The estimated value of this arrangement stands in the tens of billions of dollars, positioning Google squarely as both a major financial investor and a critical infrastructure provider. While Anthropic claims its selection of Google's chips is based purely on their efficiency and performance, a move that also diversifies its reliance away from NVIDIA and Amazon, the financial reality is undeniable. Google has already injected $3 billion into Anthropic, while Amazon has pledged $8 billion. Both dominant companies now furnish Anthropic with capital, customized silicon, and essential cloud services. Although Anthropic maintains that its strategy is merely a common multi-cloud approach, the extent to which it has become financially and operationally entangled with the three largest U.S. cloud providers, each with a profound financial stake in its success, is difficult to overlook. Then there is Elon Musk, who appears to subscribe to the philosophy that the most effective path to artificial general intelligence AGI is by having his portfolio of companies engage in deep, interconnected relationships. His AI firm, xAI, acquired Twitter, rebranded as X, which now supplies real-time data crucial for training Grok, his flagship chatbot. Furthermore, Tesla, his electric vehicle and robotics company, integrates the chatbot into its vehicles and its forthcoming humanoid robots. This structure is profoundly circular. Musk retains a majority ownership in xAI, which purchased X from him, and he holds a minority stake in Tesla, from whom he now requests investment for xAI. While not exactly an explicit case of financial incest, the deep intertwining of these corporate entities requires substantial explanation. The entire AI investment landscape is rapidly beginning to resemble less a dynamic technological boom and more a Mobius strip constructed from venture capital and raw electricity. And crucially, the electricity component is far from being a mere metaphor. Major consulting firms are sounding the alarm. McKinsey projects a staggering $5.2 trillion in capital expenditure, CapEx, dedicated to chips, data centers, and energy infrastructure over the next 5 years alone. Furthermore, Bain suggests that AI firms would need to generate an astronomical $2 trillion in annual revenue just to justify this monumental spending spree. Currently, OpenAI generates approximately $13 billion in revenue and functions essentially as a money furnace. Anthropic is a smaller furnace. This raises the critical question: who is ultimately going to foot the bill for this unparalleled infrastructure expansion? The sheer scale of announced projects borders on the unbelievable. OpenAI's Stargate project, announced earlier this year, is a $500 billion blueprint to construct 10 gigawatts GW of AI data center capacity across the U.S. To provide context, a single GW is enough electricity to power roughly 1 million average U.S. households. The full build-out committed by OpenAI is an estimated 23 gigawatts, requiring what is effectively the power output of 23 nuclear power plants. In areas like Texas, where Stargate sites are planned, electricity demand is escalating so rapidly that operators are circumventing grid hookup delays by installing on-site gas turbines. Disturbingly, the XAI data center in South Memphis reportedly operates gas turbines without emissions controls, contributing significantly to local pollution. The firms are collectively failing to generate sufficient immediate revenues to justify this astronomical spending. Furthermore, a clear, executable pathway to sustained profitability remains elusive. For a technology touted to deliver scientific breakthroughs and revolutionize human cognition, a surprising quantity of its early output is slop, simple derivative content, such as deepfakes and low-effort entertainment chatbots. OpenAI is not profitable. It is burning through capital at a rate that would induce severe post-traumatic stress in most chief financial officers. To finance its infrastructure, the company secured a highly unusual $4 billion revolving credit line from a consortium of banks. Historically, high-growth tech firms relied on equity, as lenders prefer predictable earnings. The industry's current pivot from equity to high-risk debt, secured against assets like rapidly depreciating racks of GPUs, creates a strange dynamic. The entire system appears to be leveraged purely on optimism and speculation. The GPU rental market is already exhibiting early signs of significant stress, even as the infrastructure build-out intensifies. According to analysis from FT Alphaville, the rental price for NVIDIA's cutting-edge B200 chip has begun to drop, and older hardware like the A100 is now being leased at rates that are below the break-even point for many operators. This price collapse suggests that if end-user demand fails to materialize, massive data centers built for peak usage could end up sitting half-empty, leading to the liquidation of expensive, pandemic-era GPUs. This fear is not without historical precedent. The industry is drawing parallels to the telecom bubble of the early 2000s, where firms overbuilt fiber optic networks that were never fully utilized. Today, the AI sector is deploying gigawatts of compute, effectively betting that someone will not just show up to use it, but will actually pay a premium to do so. If this bet fails, the financial repercussions will extend far beyond a few startups, hitting lenders, landlords, and even public utility providers who supported the boom. NVIDIA's colossal stock market valuation is predicated on the assumption of continuously massive and organic chip demand. The crucial question is, how much of this demand is genuine, and how much is artificially driven by NVIDIA's own financial cross-investments? When NVIDIA invests in a customer like OpenAI, and that customer uses that capital to purchase NVIDIA products, the same dollars circulate within the system, potentially inflating purchase orders and revenue projections. This circularity obscures the true quality of the revenues and fuels the bubble narrative. The reality suggests that if NVIDIA's largest customers are simultaneously its investment targets, the profit margins on those sales may not be as robust as they appear on the surface. High private market valuations for firms like OpenAI and Anthropic are only financially rational if the market evolves into a winner-take-all scenario where one dominant player emerges. This assumption is based on precedents set by Google in search and Amazon in e-commerce. However, recent developments, such as the rapid deployment of DeepSeek and Elon Musk's Grok, suggest that AI models can be replicated relatively quickly and cheaply. If the core models are fundamentally similar, the market may reward competition rather than monopoly, eroding pricing power for all players. The true winners of the AI revolution might not be the model builders at all, but the enterprises that effectively utilize the models, leading to significant productivity boosts across the global economy, while the labs themselves struggle for monetization. While the risk of a bubble persists, the financial health of the major players, Amazon, Google, Microsoft, remains exceptionally strong, capable of funding the capital expenditure without relying heavily on high-risk debt. The ultimate constraint remains the physical infrastructure, electricity. The Stargate project's reliance on power equivalent to multiple nuclear power plants is a stark reminder that the chips may be delivered on time, but the electricity likely will not be. The complexity of permitting and constructing power generation facilities, a multi-year process, poses the single greatest real-world bottleneck to the entire AI boom. The investment structures are more cautious, and balance sheets are healthier than in past bubbles. Yet, the outcome remains highly uncertain. Someone, somewhere, must ultimately bear the cost of this immense infrastructure build-out. And whether the eventual gains will justify the current, optimistic levels of investment is the final, unanswered bet the entire industry is making.